Welcome back to America's Commercial Real Estate Show. I'm Michael Bull, and this segment is brought to you by my company, Bull Realty. For asset and occupancy solutions, visit bullrealty.com. Well, we have a treat for you in this segment. We're going to talk about opportunity zones, and what a great topic. Everyone's interested in it around the country. And we're going to talk about some of the basic concepts. We're going to cover some gotchas that you really want to watch out for. And kind of the three main components to think about for opportunity zones. Please welcome my guest. It's William Delsa. He's a partner with CohnReznick, and he's here in Studio One with us. William, thanks for joining us.
Thanks, Michael. Thanks for having me here.
Well, I enjoyed, you've been on a panel, it was last night, at Real Estate Group Atlanta, and when I talk about and think about opportunity zones with the clients, I think they do have a lot of questions. So first of all, let's cover the basics. It was created by the Tax Cuts and Jobs Act of 2017, right?
Correct.
And the reasoning for it was, what are we trying to do here?
We're just trying to revitalize some economically distressed areas or tracts within the United States and some of the U.S. territories and D.C., of course.
Right. And talk to us about the basic components. So the first one is a tax deferral on a property or really almost any asset that you're selling, right?
Correct. In order for it to work, you have to have a capital gain event. It can be from the sale of stock, a property, partnership interest. That's the first component. We can't move forward if you don't have a capital gain event.
Right. And then talk to us about that. So how can, if you're selling maybe a business you own or whatever you're selling, and you can defer the gain by going into an opportunity zone, but it has to be in the opportunity zone area.
Correct.
Right. And then it has to be a kind of a renovation or a development.
It can be. It doesn't have to be. It does need to be original use. Once you have that capital gain event, the taxpayer would deploy that capital within 180 days. You have 180 days from the event. If it's, say, stock, if it's a sale of a partnership interest, it would be the tax year end of that partnership that was distributing the capital gain to the investor. So you have 180 days from that period to deploy the capital into an opportunity zone fund.
Okay.
And then it kind of just trickles down from there.
Right. But you won't get the deferral if you just buy a property and you're not spending additional cash on investment in it, right?
Yeah. So additional proceeds that are not from the capital gain can be deployed into the fund itself. It just won't receive the tax benefits that we'll go through here in a moment.
Right. But I can't buy just an apartment complex and have it operate as normal. I have to do what's...
Yeah. So in order for it to function, if it's not an original use, saying raw land where you're going to do a new construction, if it's an existing business or property, you would have to substantially rehab that project in order for it to qualify. And it would be a dollar for dollar rehab equal to the basis of the building. And that came out October of 2018, that it was strictly the basis of the building. The land component is not included in that.
Okay. So if I buy a $5 million property, the land's $1 million, then I paid $4 million for the building, I've got to spend another $4 million on the project.
Correct. And it has to be completed within 30 months.
Okay. And talk to us about that deferral. How does that work? What are the stages there?
Sure. So the investor in the fund, when they put the capital gains into it, if they hold that investment for 5 years or 5+ years, they'll get a step up in basis of 10% on their original deferred gain. If they hold it for 2 additional years or 7-year total, you would get an additional 5% step up. So in an example of $1 million of capital gain, if you held it for between years 5 and 7 and then actually sold it between 5 and 7, you would recognize $900,000 of that original gain. If you held it for an additional 2 years, you would recognize $850,000.
Okay. And of course, you're not paying any taxes on that gain until that point, right?
Exactly. So either the earlier of 12/31/2026 or if you dispose of your interest in that fund. Okay. So on 12/31/2026, it's a deemed disposition, and that original deferred gain is recognized.
Right. And here's the part that really excites me, and that is the not paying taxes on the appreciation of the property. So if we go into an opportunity zone and we purchase it correctly, we have again spend as much money dollar for dollar, and we hold that property for 10 years. We're not paying any taxes on that gain.
Yeah, and that's where the return kicker is. That's the golden goose, where if you hold that investment for 10+ years any appreciation in value from that original investment of deferred gains is tax-free. Upon disposition, you receive a step up to fair market value.
Okay, and that happens regardless if I did a tax deferral or exchange into it, right? I just come out of my cash and go into a project, right? Does it have to be something I deferred and went into? I mean, just
originally, yes. It has to be the component in which it was the original gain was put into the deal. So in our original example, where there might have been some additional proceeds you put in that were not capital gains, that component would not receive the tax-free appreciation. It would only be that original $1 million gain investment.
Okay. So if I bought a property for $10 million, and maybe in 10 years it's worth $20 million.
Yep.
Then I'm not paying taxes on that $10 million gain.
On the end. So you would have used the capital gains for your $10 million investment. You would have recognized that gain in 12/31/2026.
Right.
Hold it for an additional 3 years. That $10 million in appreciation would be tax-free.
Yeah, and that's awesome.
Yeah.
And you think about that because what capital gains is 20%.
Yep.
So you're saving $2 million.
Easy. Yeah. And then that is where if you select a property prudently where you're going to get the most return from a tax perspective.
Yeah. Now, to get that tax-free situation on the gain and appreciation of the property, do you have to hold it for 10 years?
Yes.
Okay.
Yes. You have to hit those benchmarks. 5 years for the 10%, 7 years for the additional 5, and then 10 years to get the complete wash of the additional appreciation.
All right. So if I buy that $10 million property, in 9 years it's worth $20 million. I sell it in 9 years, I'm paying taxes on that $9 million gain.
Exactly, yeah.
Okay. But if I sell it after 10 years, no, I'm not.
Correct.
Okay. What about the recapture? Let's say I've depreciated the property $1 million during that time. How does that tax on the recapture handle?
So that's a little bit of an unknown, and we're hoping to get some additional guidance on in the next couple weeks. We're supposed to be released. As currently written, you're kind of getting people on both sides where it's too good to be true, where you're getting this depreciation deduction, offsetting ordinary income, and then you're not going to be recaptured. But the basis premise of recapture is gain recognition, and so if we're not recognizing gain, currently, you could also make the assumption that you will not have a recapture event. So the depreciation will not be recaptured, which would be an additional bonus.
Yeah, so if I had that $10,000 gain that was tax-free, and maybe I've written it down $1 million, now I've got another tax-free situation.
Yeah.
Wow.
When you do apples to apples of a comparable property that's in a zone and outside of a zone, that would be a benefit. Hopefully, that will come to fruition. Okay,
let's talk about some of the timing issues, William, on this. Is there certain time frames that have to do these things to qualify?
So the first benchmark or sunset, you could say, is 12/31 of this year, of 19. And that is because of the 7-year component. So 7 years from 19 would be 2026. So if you acquired an opportunity zone property, in our context, after this year, you would lose that additional 5% step up in 2026. Okay. But at the same point in time, a prudent investor isn't going to just deploy capital at the end of this year because of just that one component. When you look at the returns strictly from a tax perspective, that 5% over a 10-year hold from a present value perspective is only about 1 or 2%. So. Yeah. Not end all be all to this.
It's still got to be a real estate deal that's worth investing in. And so let's say I am buying this $5 million property. I'm going to put another $5 million in it to renovate or rebuild it. Is there a timetable for me to spend that other $5 million?
So from the rehab perspective, yep. So the substantial rehab has to be completed after 30 months. 30 months. Yeah. So, okay. Yeah. So I could buy that property today, and I've got another 30 months to finish my. And we're kind of hoping that some additional guidance comes out on that or extends it in certain circumstances, because entitlements and so forth in of themselves can take 30 months. So we're hoping that there might be some kind of leeway with regards to that specific topic.
And some people think about the first part of the tax deferral of this in comparison to a 1031 exchange. But what's interesting about a 1031 exchange is supposed to be a like-kind property, a property held for investment trading to a property held for investment, or a property held for your business or another property held for your business. But with this opportunity zone, not so, right? It doesn't have to be like kind.
So an investor could sell stock in a publicly traded company and deploy that capital into a fund who's going to invest in real estate or an operating business. So not like kind in this case, as well as the deferral mechanisms where we're getting a step up and you're not actually recognizing the full gain.
Okay, and let's talk about entities, because there's a lot of talk around opportunity zones with funds, of people investing into a fund. But what if I'm an individual, I'm a builder, developer, and I want to just do a property myself? Can I do that?
You can. I think the term funds is scaring people just because of the current use of funds. The fund in this case is just a partnership or a C corporation that self-certifies itself as a qualified opportunity fund. So it's not like an individual can set up their own partnership, designate it as an opportunity fund, and deploy its capital into a selected property on themselves, by themselves.
Okay. And if they're going to do that and set it up as an LLC, can they do that individually, or do they need a partner?
Yeah, you would need a partner if you did an LLC because of the disregarded entity rules. An LLC can't have one owner in that case. So if you only had one owner, the best case would be either to find a minority member and or be a C corporation.
Is there any requirement for how much that minority partner has to have invested?
No, it can be any percentage.
All right, so
you basically just create, from a legal standpoint, you're creating a legal regarded entity.
Okay, so I could say, hey, congratulations, son, you're getting 1% of this deal.
Yeah, sure.
And it works.
And you had a little bit of capital gains to put into it for that 1% equity interest.
Okay.
It work.
And to find out where these opportunity funds, these zones are, how would listeners and viewers find that?
Yeah, I mean, the maps and so forth, there's an immense amount of tools that have come out specifically over the last 6 months that are mapping these areas and kind of giving you some additional details. So, I mean, you can go to the federal government's websites, or you can go to CohnReznick.com and it'll lead you to the maps to make sure. A lot of the tools, they're kind of layering in some additional components with regards to those tracks to try to make better investment decisions.
Right. I think there's also a third component to opportunity zones. You think about the tax deferral of something that you're selling and you go into an investment in a zone. You also think about the appreciation of potentially owning it 10 years and not paying taxes of the gain. I think the third component is what happens in these areas, right? I mean, all this was done to create benefit for those areas, right?
Yep.
So that could be another benefit.
It's definitely. I mean, the whole point of putting this legislation in was to revitalize and bring private equity sources into these areas to develop and hopefully raise the wages of the people who are living in those communities, the value of those properties, so that way it can be a long-term sustainable community for low-income individuals.
Yeah, and it makes sense if you're looking at a couple of properties and one of them's in an opportunity zone, one's not. You might think, hey, maybe the property in the opportunity zone might appreciate more because of all the development going on around it.
Exactly.
Tell us about what you're seeing and some of the kind of case studies of what some investors, developers, and these funds are doing around opportunity zone deals right now.
So I'd say the investors or the deals that are going right now that I'm seeing is in the multifamily facet. We're seeing a lot of student housing as well, because a lot of the tracts that were designated are around colleges and universities, and so students are incomeless. So therefore, when the census was done, they're designated in the tracts. So we're seeing a lot of student housing. We're seeing a lot of multifamily housing, but everything right now is kind of just getting up its ground. I would say 2018 was the learning year, and 2019 thus far, and I'm sure it will be the deployment year, and where transactions are actually getting signed and done. Yeah,
and if you think of real estate, of location, and you only want to buy in the best areas, it's interesting to note that these areas were designated based on the 2010 U.S. Census data, right?
Correct.
And then the governors of each state kind of chose but they can use that as a basis?
Yeah, so that was like their starting point or the parameters and for their decision. So the governors of each state had to select and provide to Treasury the areas, the tracts in which they wanted to designate as opportunity zone funds. And they could also designate a small percentage of non-opportunity zone or tracts that were connected to low-income communities.
Yeah, and that's interesting because since 2010, a lot of things have changed.
Yes.
I mean, the market is really improved in a lot of areas. So you might find when you look at these opportunity zones that they're in some great areas at times. Well, what are some gotchas, William, that people should watch out for here?
Yeah, I think everyone's starting to get the mechanics of the opportunity zones A, B, C, and D, but you do need to look at the related party rules. Those are going to trip up a lot of people. You can't create a capital gain event from a related party, as well as if you sold in our example, if you sold a property in 2018, 2019, we'll say today, you can't then put that money into an opportunity zone fund that you own more than 20% of. So the related party rules, I think, are going to trip people up. Yeah. As well as there's still a lot of questions surrounding basis. When you put your deferred gain into the fund, your basis is zero, and whether or not if it's a debt levered deal, whether you're going to be able to use that leverage in order to have 704B basis, not to get too technical, to be able to utilize those losses at the investor level, as well as if you pull out cash from operations or from a refinance.
Yeah.
So I think in the next couple of weeks that's going to be something that they're going to release additional guidance. The additional guidance we'll talk about.
Yeah, well, it's excellent. And William, thanks for joining us. That's great information on opportunity zones.
Yeah, no problem. Thank you for having me.
All right. And if you'd like more information, we'll have some links on the show website at CREshow.com. And let us know what you think. Share some comments, share the show. We appreciate you sharing and connecting with us on LinkedIn and Facebook and Twitter. You can find all our connections at CREshow.com. And thanks for joining us. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com. BOMI International. For facilities and property management education, visit BOMI.org. BuyProxy.com. Your global commercial real estate listing service. Visit BuyProxy.com. Red IQ. Turning multifamily data into actionable intelligence. Visit RedIQ.com.